Hello, everyone, and thank you so much for coming to our presentation tonight. This is a good one. This is actually probably my favorite. And the reason I say that is, in the investment world, it's never fun. And what I mean by that is, as you're going through the investments and you're looking at the markets and the economy and what's doing well, what's expensive, what's cheap, things can stay cheap for a long time. Things can stay expensive for a long time. Things can move like they've never moved before, and it's a little bit like sticking Jello to the wall. Taxes, on the other hand, are a little bit easier to work with. There's a law, you have your situation, you analyze the law, analyze your situation, and figure out which way to kind of maximize the benefits. And it's very cut and dry. If we implement this, we get to save this. Um, so clean, so easy. So today's presentation is kind of a cheat sheet where I go through one, the basics of tax planning in terms of 101s and the things you want to think about. Two, then I'm going to rattle off a case study with kind of a dozen strategies that may or may not make sense for you. So at the end, what I'm really hoping for is you pick up a thing or two that you might find useful that you can implement, and then just shoot me an email. Hey, Mike, I just want to have a further conversation on one, two, and three. And then we can kind of analyze it and see if it makes sense for you. So, with no further ado, let's go into our presentation. This is probably my favorite slide, or the slide that I want to have stick with you after this presentation. So what is this really describing? This is simply the concept that you think taxes should be simple. The more I make, the more I have to pay, straightforward, not a lot of moving parts. The problem is the tax code is taller than me if you were to stand it up. It's thousands upon thousands of pages. Now, the tax code is riddled with what I would call gotchas. Situations where you're a dollar or two into the next bracket and you might double the taxes you owe, or you might dramatically increase and you didn't even realize it. So again, you want to be cognizant of where the gotchas are built into the tax code. And sadly, as you're going to find out, it's not as straight as federal income tax. There's kind of five or six different realities that you need to incorporate as you're coming up with your tax strategy. First and foremost, we have our kind of federal tax brackets. As you Most of the people on this call, there's a few out of staters, but for New Jersey has an income tax as well, so that's an additional one that you have to factor in as you're coming up with your tax plan. But we have what's called a progressive tax system. So federally, it's a pretty simple story. The more money you make, the higher tax bracket you're going to find yourself in. And there's varying numbers for married filing joint and for single. So that seems like a very simple concept. Now, as we take a little bit of a deeper dive into the numbers and into the brackets, a couple things stand out to us. One, there's two big cliffs built into the tax code. Or we'll say jump, depending on which way you're going. So the 12% to 22, that's almost a double. So as we're taking money out of an IRA, and everything's going accordingly, and we're doing what we need to stay in the 12% bracket, and we find ourselves in November or December, and we say, oh crap, we need 10 grand in a hurry, and we go to do that IRA one-time distribution. But when that puts us over the limit, instead of it costing us 12%, it's going to cost us almost double at 22%. So having a very good understanding, a large part of what I do for clients, is just understanding where our income's going to be. Are we close to those brackets? Now, if you're in the 22 to 24, not as important. But that leap from 24 to 32, that's also an additional one to be cognizant of. So I'm going to quickly go back to just kind of point out where those are. So the 22% bracket, or where it jumps to 22, is this 96,000 here, but you have to factor in the standard deduction as well. So tack on roughly 30 grand onto this number. So if I was going to use a round number, around 125,000 of income for married filing joint, that's when I have to be very cognizant of how much income we're going to trigger at that point. Maybe that's where you're going to stop, say, I'm not going to take any more from an IRA. I'm just going to withdraw from a Roth IRA, or I'm just going to use money from a bank account. But it's very important if your budget's around there. Again, if your budget's 180, tomato tomato. You're nowhere near that bracket. Don't even have it really factor into your equation that much. But again, when you're close, it's very important because that's a big jump in what you're going to owe in taxes if you're not paying attention. Another thing to keep in mind, so we have income tax rate and capital gains rate. So what we're looking at here is long-term capital gains rate. So this is a situation where you have an asset, such as a piece of property or a stock, and if we hold it for longer than a year, these are the rates that we're going to pay. So again, we want to be cognizant of what is my income looking like. Let's say our total income for a married couple is going to be 75 grand. Well, we have an opportunity here. We got another 20 grand at our disposal that we could sell a stock. Maybe because stocks have done so phenomenal, we're at all-time high. Maybe it's too big of our net worth that we feel comfortable with. We can kind of trim around the hedges of that stock, maybe sell 5, 10% and pay 0% tax on it if we're falling below 96,000. I can't begin to tell you how hard it is to earn solid rates of returns and make the right moves. You know, you have to spend a lot of time and energy on that. But where people, I find, give away free money back to the government is not understanding the tax code. There are situations where I tell people do this, this, and this, and I'm going to save you 25%. I can't magically create someone 25% rate of return. Those things don't exist out there. So let's not give up the free 25% scenarios or the 15% scenarios or whatever it may be. But this is where we want to be on the ball is with regard to the tax code. Because like I said, the investment side is hard to do. So let's not give away the free handouts. This 15% bracket's where a lot of people are just going to fall. It's obviously a humongous bucket. So if you're squarely in the middle of it, again, this is one of the things you can kind of shut your brain off to that reality. There are like I said, there's 5 or 6 things we want to think about. And every person's situation is unique. There might be, I might sit down with you and say, Mr. and Mrs. Smith, these 2, don't even worry about it. It's never going to be coming to a play for us. So we got to focus on these 4. Now, this is one of those things that for the most of the people on the call tonight, it's just not going to happen. So this is with regard to the taxation of Social Security. Some people were hoping that was going to be included in the so-called Big Beautiful Bill. It was not. I think that's a good thing in the long run. The reason I say that, and this is not for this conversation, I also present on the Social Security system. Social Security, as you may have heard, is the trust fund's kind of running dry in arguably 6 to 9 years. That's a scary thing. Social Security taxing us is one of the ways to keep it going. So if we were to cut that off, we're just saying we're going to, have that pool of money run dry faster. So it is still a reality. One of the problems with taxation of Social Security, they never indexed it for inflation. So what may have been larger numbers for kind of the middle of the road or, kind of middle income individuals, now it's catching almost everyone. So how is the taxation of Social Security? How does it work? First, you need to determine what's called your provisional income. So what they do is they find out what your modified adjusted gross income is. Long story short, it's all of your income, and then you add back municipal bond interest, which normally is not counted. It is counted for this particular situation. So add up all those things. Maybe it's rental income, maybe it's a pension, maybe it's a part-time job, interest and dividends. And then they say that plus half of your Social Security. If those 2 things add up to, let's say, married filing joint is more than 44,000, which almost everyone in the call is going to be in that reality, up to 85% of your Social Security is going to become taxable. So what I'm not saying is the tax is 85% of it. So to just run through a quick example, just to use nice round numbers, let's say your Social Security was 10 grand and you fell into the bracket that was going to be 85% taxable. So you got 10 grand, they're going to say 8,500 will get added on to your taxable income, and that 8,500 will be taxed at your tax bracket. So, let's say you're in the 20 or 25% bracket, the cost is going to be roughly 2 grand out of the 10 grand that you received from Social Security. Again, if your budget's going to be well above this, 70, 80, 90, 100, 150,000, this is one of those categories that like, oh, that stinks, but it's going to be a reality. Another big one is Medicare premiums. So if we could just go through an example, let's say someone is a individual and their income is 106,000 or less, Medicare is going to take it out of your Social Security check, $185 every month forever. And that number is going to go up. So what a lot of people experience is, I thought Social Security was getting a raise of 3% this year. Yes, but maybe the Medicare portion went up 9%. Um, this is one way of the government give you from one hand, but take it back in the other hand. Now, this is one of those situations where if we just bump ourselves a dollar into that next bracket, we can trigger a 40% increase in our Medicare premiums. This 185 to 259, that's a 40% increase. So if we're not paying attention and we just took an extra 10 grand out of an IRA where maybe we should have took it from the Roth or an after tax, and can have a dramatic impact. In saying that, I've had a few clients reach out to Medicare and we're able to negotiate, say, give them the sob story, this happened. So just know if this does play out to you, sometimes a phone call, which costs you nothing, might be able to bump it back down. The other thing to be cognizant of here, it's looking from 2 years prior. So if you retire and your income before was 220 grand for your household, but now it's 100, I would certainly call Medicare and say, hey, I've had a change of circumstances. Please utilize this income kind of going forward. They have been reasonable in that regards. But again, we want to be cognizant if we're close to these brackets. The Senior Freeze Program. So New Jersey now has 3 different programs that we need to be cognizant of. You have the New Jersey Property Tax Freeze. That's roughly 168,000 of income or less. You're going to qualify for that. That's where you can, let's say your property taxes were 10 grand. You can maintain that going forward. As property taxes increases for everyone else, yours freezes. You have the Anchor program and then the Stay New Jersey program. Those are much bigger thresholds at 250,000 and 500,000. But for our purposes, if I'm trying to think of that first one that's triggering, that property tax freeze at 168,000. This is where gotchas, and you kind of have to think multi-dimensional when you're thinking about your taxes. If someone say, "Oh, what's my income?" Well, I have a pension, I have Social Security, and I'm taking 4,000 a month from my IRA. All right, that puts me at a good pace to stay under it. New Jersey looks at all income as income. So if at the end of the year, oh, my ABC stock has done phenomenal and markets are high, they're expensive. I think we're going to have a problem. I want to hedge my bet and I'm going to sell half the position. Good, reasonable, prudent thought process, but that is income. So maybe you sold something that was 70 grand. Oh, that gets added onto your taxable income. Oh, you lost your property tax freeze and you got to start the whole process over again. So you just want to be, everything sadly has a bunch of ripple effects. So again, as I may have mentioned at the beginning of this call, if anything I say here seems like it'd be a good idea for you to do, talk to me first. I would hate for you to hear 5 minutes of a recommendation, implement it, and I didn't tell you, all right, you got to think about 2, 3, and 4 before you do something like that. So I had a whole bunch of tax updates, which all seem relatively small now, considering the so-called Big Beautiful Bill has passed. Now, I probably will do a whole seminar on that bill because there's a lot of moving parts. It's 940 pages. Now, some of the bigger ticket items that's going to impact a lot of my clients. One, we're in a blue state, and we were hit with what was called the SALT cap. That's just state and local tax deduction. We used to be able to deduct 100% of what we paid to the state, and that was brought all the way down to 10,000. That's really brutal. Brutal. A lot of people's property taxes were already over that, so that cap was extremely painful. But for the next 5 years, that cap is going to go from 10 grand to 40 grand. There are some income limits, but I think it's around 500,000. So for the majority of people in the state, that's a huge number. That might capture 100% of what you pay for state income taxes or state property taxes. So there was probably some things I was recommending before When the cap was 10 grand, now those go away because that has moved from 10 to 40. So a lot more people that were probably using a standard deduction are now going to itemize. That's a whole different frame of mind. So you need to have a conversation with yourself and your professionals. All right, based on this gigantic move, do I need to do anything different? 2, for individuals 65 and older, for the next few years, I believe it runs till 2028 or 2029, you'll get an additional $6,000 standard deduction each. That is phenomenal. Now there are phase outs. We're talking between, it slowly phases out between individuals between 75,000 and 175,000, for married filing joint between 150 and 250. But for a couple, it's an additional $12,000. That's not nothing. So again, it goes back to maybe I won't itemize now because now my standard deduction is, 42, 43,000. Again, we just need to know, all right, we're going to use the standard deduction. Beautiful. Then we're going to use this playbook. We're going to itemize. Then we're going to use this playbook. You just need to have those conversations. For those individuals that are going to use standard deductions, one nice feature is you're able to do a charitable contribution for 1,000 for an individual, 2,000 for a married filing joint. That's a nice little feature because where a lot of people before were saying, "Oh, I normally got a tax deduction when I made the charitable contribution," but because they no longer itemize, you didn't get any benefit. There is definitely smart ways to give charitable contributions, which we're going to go over in a few slides. Um, but again, that's my knowledge of the big beautiful bill is certainly a work in progress. Over the next month, I'm going to kind of finalize and probably, like I said, create a whole presentation around it. Some things additionally on this slide that helps, for those that are still working, there is additional contributions that you can make to your 401k. I'm always a proponent of using any tax advantage vehicles, 401ks, IRAs, Roths, HSAs. Take advantage of every single one of them. For those of you who had the RMDs, which used to have a painful, which was your required minimum distribution. If you missed it, it used to be a 50% penalty. Now they reduced it to 25, and if you do it in a timely manner, they lower it to 10. A little bit easier. One interesting planning technique for those individuals that are in a very fortunate situation, you can create 529s for kids or grandkids, or actually even for yourself, where you can eventually use it after 15 years, where you move that from a 529, which is really designed for education purposes. If it's not used for education, you can move it over to a Roth IRA. And now it continues tax-free growth for all of time. So this also might be individuals that are like, hey, we didn't end up using a 529. That's a very nice feature to have at your disposal. So to recap kind of part one of our conversation, there's a few different things that we want to factor into every time we're coming up with a tax budget. Where the tax brackets are. Am I close to those big leaps? Am I going to be close to where Social Security becomes taxable or not taxable? What are the New Jersey programs? Where's the Medicare premiums? And one slide I don't have here is the additional kind of New Jersey tax rates, if that does apply to you. But sadly, you have to look at your taxes from those 4 or 5 angles. And you just need to be cognizant of where those leaps are or where those gotchas are. Again, that's something I can certainly kind of walk through with you. And like I mentioned, part 2, I'm going to go through a whole bunch of strategies. Now, these are strategies I'm going to touch on for 1 or 2 minutes. Again, please do not go right into implementation mode. These all could be 20-minute conversations. So I recommend just writing down just the 1 or 2 that you think you want to have a follow-up conversation on. Again, happy to help. I just want to knock out a no-brainer. We fill up our tax advantage accounts, HSA, health savings account. That is a gift. There's really nothing else out there where you can get a tax deduction for putting it in. And as long as it's used for health reasons, at some point in your life, it comes out tax-free. That's getting best of both worlds. Fill up that bucket every time. FSA, flex spending account, you don't get to keep it with you over the end of the year, again, for use for health purposes, but a phenomenal tool. But you want to be cognizant, it's one of those, if you don't use it, you'll lose it. Typically a company either has the HSA available or the FSA. But both, if we put $1,000 into an FSA and use it for medical purposes, and you find yourself between federal and state at a 30% tax rate, you save $300. Like I mentioned, it's very hard to squeeze out extra return in the markets. If I could squeeze out extra return when it comes to the tax code, take advantage of every opportunity. 3, always and forever build up your Roth and pre-tax. Now, depending on your tax situation, I might lean more towards pre-tax or towards Roth or a combination of the two. But I cringe when I meet someone for the first time and they just weren't utilizing the Roth, and they're making investments inside of a taxable account or a joint account. In that account, you got a partner. You got 2 partners, Uncle Sam in the state of New Jersey. And depending on your tax bracket, they might be taking 35% of your cut. That's brutal. I want to be somewhere where I'm either getting a tax deduction or I want it to be tax-free for all of time. Just fill up everything at your disposal. These are kind of the no-brainer handout. Now, right now, I'm going to kind of walk you through a case study. I want you to kind of put yourself in these shoes, and I'm going to, again, walk through situations where I've heard 1,000,001 quotes or people saying X, and I'm going to provide why we don't want to do X. So to walk through this, here's Sam and Mary, both 60 years old. They plan on retiring at 63, and they want to turn on Social Security at 66. Okay, starting to get a little bit of a framework around what they want to accomplish. Okay, now they've done a fantastic job. They built up a nice nest egg. So if we add this up, they're right around $2 million. Beautiful. You're kind of sitting pretty, and we want to spend 12,500. So as I'm thinking about their situation in my head. All right, it's 150 grand. Out of they got $2 million, they're going to get Social Security. That probably means they're going to distribute 4 or 5% of their principal every year. All right, that's a good pace. So I like the pace. Now, as I go one layer deeper, I don't mind the pace they're taking, but I can tell we're going to have a problem. That's because as I'm looking at the assets, 90% of their assets are pre-tax. So we've got this 900, this 9 is 1.8 out of the 2 million, or 90% is pre-tax. We're going to have a really tough time controlling our tax brackets for the next 35 years. Again, if we want to try and stay around that 125,000 to stay in that 12% bracket, we're going to exhaust the joint money and the Roth money pretty quickly, maybe in the first third of their retirement. So, we're coming in kind of hot, coming in kind of top heavy pre-tax. In the perfect world, I try and tell people if we have 35% after tax and Roth, we're at a pretty good spot. We're probably going to be able to control our tax bracket to a pretty high degree throughout our retirement. So, all right, we pick up on a few things. They want to retire at 63. We're not going to turn on Social Security until 66. So we're going to have a few different brackets over the next 10 years. So while they're working right now, they're in the 24% bracket. All right, understood. They're eventually going to have RMDs in their 70s, where they'll be forced to take money out of their IRAs and 401ks. So that'll probably put them in the 22% bracket. But we're going to have a period of time between 63 and 73 where we could be in a 0% bracket, 12% bracket, 22% bracket. We need to take advantage of this time period. Like I mentioned before, we were coming in hot. We were coming in very heavy pre-tax retirement accounts. Maybe for a few of those years, we're either going to process Roth conversions because we get to convert at a low tax bracket, or we're going to take some distributions, again, up to the point where it's the 12%, then we'd probably slow down. But we need to take advantage of whatever is at our disposal. Oh, beautiful. We got some years where we're going to be in a low bracket. Take advantage of it. So again, you kind of want to think through the different phases of your life. This is, again, as I sit down with someone new, you hear different things. A lot of times people come in, they like to trade stocks. More power to you. Have some fun. I get the idea, the concept, the enjoyment one might have of it. But we need to be cognizant of where we're doing such things. So we want to be passive in a taxable account. Frankly, 9 times out of 10, when I see people's stock account, it's a taxable account. So when we're doing trades and we bought something 6 months ago and we're selling it now, and maybe we did a beautiful job, we made a whole bunch of money and we sell, we're paying short-term capital gains. That is painful. We do not want that. So the investments inside your taxable account, we really don't want to be doing too many buys and sells. Certainly, if possible, we would want to wait a year. So we want to have those types of investments in mind. If you're doing something for a trade where you probably know you're going to get it in a month or 2 months or 3 months, do it in your IRA and your Roth. You don't want to do anything like that in your taxable accounts. You tend to want to be passive. Index approach are fantastic. Now, something that comes up all the time is, when changeovers happen, you got to change a whole bunch of different categories. Like we were mentioning before, in Sam and Mary's situation, they were in the 24% bracket, then we're in the 0% bracket. Maybe between federal and state, it made sense to be in muni bonds. Well, now we're in retirement and we drop down to the 12% bracket. Now it no longer makes sense to be in muni bonds. So you want to have the conversation, should I be in corporates and treasuries, or should I be a little bit more in munis, or should I have a combination of the two? But again, as your tax bracket changes, you might want to look at the different types of interest you're receiving. Maybe it makes sense to do a change. Another classic thing I hear all the time, to keep things simple, we kept all the accounts the same. So someone has an IRA, a Roth, and taxable, I'll see them all in the same models, which should never be the case. I have models designed for qualified accounts for IRAs and Roths, and models designed for taxable accounts. Very different investments. At the same time, think of the Roth and an IRA. Roth is tax-free for all of time. IRA, you're always going to have a partner. So whenever you want to touch it, your partner gets a cut too. So Roth, we want to grow the fastest and the most because that's all going to be yours. Your IRA, you want it to kind of, out of the two, grow the least. So to use a quick little example, let's say your risk tolerance, where you feel comfortable, is 50-50 stocks to bonds. Well, you still might be 50-50, but maybe your IRA is a little bit more conservative on that line and your Roth's a little bit more aggressive. So the net effect of the two is 50-50, but we're top heavy in the things that probably will grow the most in the Roth and a little bit more conservative, a little bit more bond focused within the IRA. Now, again, you need to be cognizant. A lot of people have, you know, 5, 6, 7 times more in an IRA than a Roth. So that, again, that has to be factored in as well. But you want to be cognizant of those two realities. One, you're going to have a partner, one, you're not. I sold the stock at a big loss, figuring I would carry the loss until I had gains in future years. So let's walk through a little example. You know, I had some clients that worked for companies that did not do so well in the 2008 financial crisis. So they just had stocks that were at a just complete bath. It's just a reality. They're never coming back. They technically never went bankrupt, but they're never going to go back to anywhere near. Maybe let's pretend they lost 99% of their value. Some people just blanket sell it all because federally, that's not a bad strategy. So how it works is when you sell something, the government's going to look at all your buys and sells throughout the year, and they're going to net everything out. So let's say, you had a $200,000 loss and only a $10,000 gain. Well, they're going to net out and federally say, all right, we're going to do you a solid. That net of $190,000 loss, you get to carry it forward with you. So if you don't have any gains that you can wipe with the loss, you could take 3,000 of that loss and lower your other income. Let's say you're working a salary, you get to lower it by 3,000. That's not a bad deal. New Jersey says, no, we're not going to be so kind. So let's say you sold the whole big thing for $200,000 loss. New Jersey's going to say, oh, what can you net out? 10 grand, beautiful. That other $190,000 loss that you booked, it's gone for all of time. You want to be careful of how much you're going to lose. So for a lot of my clients that have that position that is just always going to have a loss, I only sell enough to wipe away all the gains and to utilize the $3,000 loss. We don't want to just blanket sell it if they're in again, if you live in Florida, no big deal. Or any no tax, no big deal. Then absolutely go ahead. Um, but for New Jersey, you can't carry it forward. It's kind of a really big waste of money to sell the whole thing. I love ABC stock. It's going to come back. So let's say you bought ABC stock and you love the story, you think it's going to go to the moon, but markets just went through a bad period of time. So it went from $100 to $70, but you're confident it's going to come back. Now, one of the things we can try and do is what's called tax loss harvesting. So I'm going to use an example, let's say in the index world. Let's say you bought a US stock fund from one of the big companies, and you're going to hold US stocks forever. So you put in 100 grand, the stock market just took a recent bath because of XYZ problem, and the 100 grand went to 70. What we can do is sell that and buy something identical from one of the other big fund families. So if the market turns, we won't miss it. But now we get to capture that loss and use it on our tax return. So although our investments are going to really stay the same, we just want to process that transaction to utilize that loss on our tax return. We were so upset that our accounts went down, we didn't open the statements. Now, I'll hear that a lot in a painful time, and that's probably not half bad. If you could just say, oh, it's better for me to just close my eyes. I know it's eventually going to come back, and I'm just going to leave it alone. It's not terrible advice. What I would try and push people to do is we can't avoid downturns. That's a reality. I would love if I could. I would not be here. I'd be on some island somewhere. But in saying that, everything that plays out with your finances, the goal is to simply take advantage of it. All right. We're in a high tax bracket. How can we take advantage of it? We're in a low tax bracket. How do we take advantage of it? Markets are high. Let's do some things. Markets are low. We're doing other things. Everything has its own playbook. So when we find a situation where, the markets are going through one of their painful periods, fantastic time to do Roth conversions. I typically have just a simple grid when I'm walking over whether I want or recommend someone do a Roth conversion or not. Are you in high income or low income? Is the market high or low? If we find ourselves going back to our example of Sam and Mary, and maybe they're fortunate, maybe they are 64 years old, so they're not working, they're in a low bracket, and the market gives us a dip of 20, 30%. Oh, that's a fantastic time to play catch up. Fantastic time to get our ratios back to where we want between pre-tax and after-tax money. So again, we can't avoid the downturn, but don't freeze, kind of deer in headlight style. Take advantage of it. We were over the income limit, so we didn't think we could contribute. So, we have the ability to contribute to 401ks and IRAs and Roths. So let's say you've done a fantastic job and you've maxed out your 401k and you still want to save additional money because still got good cash flow. But you say, oh, I make too much money to deduct an IRA contribution and I make too much money to contribute to a Roth. What you can do then is what's called a backdoor Roth. Again, this only works if you don't have other IRA money. Please do not do this unless you speak to me first. But what you can do is contribute, let's say, if you're older than 50, $8,000 to a non-deductible IRA, and then immediately convert it to a Roth. And considering that you did not take a tax deduction on the IRA and the IRA did not have any growth, when you do that conversion, there's nothing taxable. So now we were kind of backdoor, got money into a Roth growing tax-free for all of time. Another thing you can look to take advantage of, some 401ks, typically bigger companies, allow for after-tax 401k contributions. So let's say you've maxed yourself out up to the 31,000 into the 401k, and you want to put away additional 10,000. Some 401ks allow you to put 10,000 in after tax, and eventually when you retire, you can roll that over to a Roth IRA. It's incredible to me that rule exists, but it does. So again, these are two ways. If you've done a fantastic job, you maxed everything out of kind of sneakily getting additional money into a tax advantage vehicle. Tax efficient charitable contributions. This makes a very big difference. Now, first and foremost, anytime you give to charities, fantastic time. You'll never hear otherwise from me. But for the individuals that, we just typically cut a check to the charity, it's really a big missed opportunity. So these are a few different ways of tax efficiently giving to charity. Now, this first one here, double up charity to itemized deductions. Now that the SALT cap has been moved from 10,000 to 40,000, that's almost never going to come into play. So I'm not going to really go into that strategy. But here's the three other ones are fantastic. So, all right, one, we can cut a check. So put 5,000, give them 5,000. The other way, and hopefully we can itemize and get a tax deduction. But let's see if we can get not only 2 for 1, let's see if we can get 3 for 1. So we gave to charity, which is fantastic. 2, we get to itemize on our tax return, we get tax deduction there. 3, let's say we bought ABC stock a long time ago. We just held it forever. So let's say our cost basis is, I'm just going to say 0, just to use nice round numbers. And it's now worth 10 grand, or let's say we bought it for $1. So we have a $10,000 gain and say, hey, I want to use this stock. I'm going to sell it to fund my charitable contribution. Or if we sell it, Uncle Sam gets his piece and the state of New Jersey will get their piece. Now we'll get a tax deduction, but we're kind of created a wash. Well, most large charities, you can gift the stock in stock form. So you have ABC Company and you want to give to St. Jude's. I know for 100% certainty St. Jude's will accept it, that you could just transfer the stock directly to them. So we gave to charity, we'll get a tax deduction, consider we're going to itemize, and we got to avoid the capital gains sales tax in New Jersey and the feds. Oh, that's fantastic. That's a fantastic rate of return. And we didn't have to know some magical thing about the markets. We were able to do it by just being tax efficient. Donor advised funds. I don't think that's going to pertain to too many people on the call tonight, but these are fantastic if you have a sellable business. So let's say, I make 100 a year, 100K a year, 100K a year, but when I eventually sell it, I'm going to sell it for 3 million bucks. So you're going to have a huge tax increase for the 1 year, and then it's going to go way back down. So what we want, and let's say we like to give 5,000 to charity every year. Well, that $5,000 deduction going forward is going to be worth much less because we're going to be in a lower bracket. We really would want to hopefully get the next 25 years of our tax deductions up front in this really high tax year. So what you can do is I'm going to make 3 million bucks, but I'm going to put 100,000 into a donor advised fund. Donor advised funds allows you to take that full 100 grand deduction in that year where you had the really high bracket. Now that 100,000 is in a donor advised fund. Think it's like an account that you manage, you can invest it, and then over the next 10, 20 years, you can dole it out in whatever dollar amounts to whatever charities you want. So we got the charitable deduction in the best year, but we could still systematically give it to charity over the course of your life. Again, those are great where you're going to have a one-off huge tax hit. And so the last one is what's called your qualified charitable deduction, where you send it directly from your IRA or 401k to your RMD. I stand corrected that this only works for IRAs. Do not do this with your 401ks. So this is where, hey, you have 100 grand in an IRA and your required minimum distribution is 4 grand. You can tell your IRA, hey, cut $1,000 check to ABC charity. Don't take possession of it. The funds go right from the IRA to the charity, and it's as if it's not going to be taxable to you for federal purposes. Again, New Jersey says, yeah, no, we still want to tax that. New Jersey is a little more painful to deal with. But again, appreciate it for 99% of people. Appreciate Securities, fantastic place. Directly from your RMD, another fantastic place. Some questions that come up is, hey, I'm 64, can I do it from my IRA? No, it has to be from your RMD, which depending on your age, kicks on at 72, 73, or 75. These are big ones. This is where people lose a lot of money. So mom needs a nursing home. So we were using her bank account since it was the one we had easy access to. It's foolish. So, nursing homes and assisted living facilities can get very expensive very quickly. So let's say you're spending 14,000 a month, and let's use kind of Sam and Mary. It's 1.8 million in pre-tax retirement accounts. Well, if you have high medical expenses, aka assisted living facility nursing homes, those are medically deductible. So you might have $100,000 tax deduction. So we want to use pre-tax sources because if the money comes out of the IRA pre-tax, this huge tax deduction is going to wipe it away. So if we have high medical expenses, we want to be leaning on pre-tax money to kind of fund those bills. Certain types of annuities are good for that as well. Again, if we're having a situation where someone is costing this much and we have these our resources, come talk to me. I'll give you the game plan of what makes the most sense. I was nervous the government was going to tax my estate, so I moved the house into my son's name. This is a very common practice. You think someone's going to get what you've built, and I get that you want to protect your nest egg, you want to protect that inheritance, but sometimes, if not done right, it's going to cause way more harm than good. So let's go through an example. All right, mom gifts the house to the son. The mom bought the house in 1978 for 100 grand, and now it's worth $1 million. And she gifted it to him while she was alive. And then she eventually passes away. Now, this is not the son's primary residence. So this is more or less a second property or investment property. So he goes to sell it. It's $1 million. He was gifted the cost basis. So her cost basis was 100 grand. Now his cost basis is 100 grand. So he's looking at a $900,000 gain. Uncle Sam in St. New Jersey says, "Thank you so much." Because what you didn't get access to was the step up at death. So this is a situation where if he inherited it upon her passing, the new cost basis would not be the 100 grand, it would be the $1 million. So when he would go to sell it, there would be no tax. Now, this is a complicated scenario because we have long-term care and Medicaid, and maybe that's part of the angle. These aren't easy conversations. But anytime we're moving, it's always something that's incredible to me. Like little signatures could just move millions of dollars very quickly. Anytime where you're changing deeds or moving assets in and out of name, highly recommend speaking to someone. Because again, you might be solving one problem, but you might be making another problem much bigger. Now, that was kind of all the different strategies. Something I'm doing now is I go over 3 slides, because sometimes I discuss Social Security, long-term care, investments. Financial planning really gets boiled down to a few handful of things. If you do these things right, or, that's the majority of it. That's the meat and potatoes. Something I try and do for all of my clients is you have investments, you have pensions, you have Social Security, you have your budgets. Everything needs to tie into a cash flow. Because the first question you have to answer yourself of when I can retire is, all right, based on my budget, am I going to be okay? If we factor in inflation, am I going to not run out of money? Cash flow is where everything gets tied together. You should be able to sit here and say, all right, well, based on my incomes between pensions and Social Securities, my distributions from my investments, the budget I want to live on throughout my life, I should be able to look at this column all the way to the right where this 1.7 is, and I should say it stay black the whole time. If not, we got to go back to the drawing board. So a lot of people have heard me say, you get a few dials to play with. When you stop working full time, what your budget is, whether you do part time, what's the risk tolerance you have, whether you're going to relocate out of state. These are the dials we get to play with to find our own personal sweet spot. But again, whatever the combination is, it has to work. I have to be looking at a plan that is sustainable over your lifetime. So again, I always go back to this slide because this is the most important thing I go over with clients. Now, something to factor in this is your life, your financial life on paper. My world, more or less what I do for a living, is to understand and become an expert on your five main categories of financial planning: estate, elder care planning, tax, retirement planning, investments, risk or insurance planning. And I understand probability based on scenarios, and I try and create efficiencies within your financial plan. And then I also have to become an expert on you, and you should be an expert on you and say, well, is fear a big motivator for you? Kind of herd mentality. I was watching the news and everyone's doing X, I want to do X. Greed, fear of missing out. And a lot of people, my cousin said, or Sue from the office said this, or is doing this. You got to be careful of these. These allow for snap emotional decisions, which may or may not be in your best interest. So, this is financial planning in a nutshell. Understanding you and the emotions that go into your financial plan and making sure you can confidently check off the boxes for all of these. This gets us, all right, if I do my cash flow and I'm cognizant, I feel good about all these categories, then the last piece, and kind of where my business has transitioned to a little bit, just kind of where the puck has moved, you know, money is typically not lost between 71 and 72 years old, or 67 and 68. It's transitions you have to get right. There's four big transitions. My old man passed away, and I saw it firsthand. A situation where in my own personal household, or my parents' household, my father did a lot of the finances, kind of made a lot of the decisions. Everybody's households are different, and he didn't want to face the music, didn't want to face the end, so didn't do a lot of planning. And then my mother was left kind of high and dry, not typically educated. This is an emotional time to make decisions, and ready, set, go, make decisions. It's tough, and a lot of people get hit with that in the face. So, doing planning around widowhood and making sure both parties understand, feel comfortable, just have these conversations. Obviously, retirement is a big transition. When you're going to retire, that budget is, if it's sustainable. When am I turning on Social Security? Have I thought about the taxes? You got 4 or 5 Medicare, healthcare. There's a lot moving around there. So that's obviously one where we take very seriously. Of course, elder care planning, like I mentioned, you know, you want to speak to an accountant or a financial planner. Am I doing this right? Because hundreds of thousands of dollars are moving at once. And there's a very big difference between doing it right and doing it wrong. And obviously, estate planning, assets and legacy planning is a big part of this too. But, a lot of things get done right, and then an emotional transition plays out, and people didn't think about those. So again, keep those. You want to have these conversations. Last but not least, one, fantastic job. Welcome to the education portion. That was tonight. Now, like I mentioned at the beginning of the seminar, if there are things that interest you or things that might be beneficial to you, hopefully you wrote them down. Shoot me an email, give the office a call. I'm happy to sit down one-on-one and say, all right, if we're going to do this, this is why it makes sense. This is why it doesn't make. Here's the pros and cons. Here's the other ramifications. And yes, we might implement, or two, maybe this one over here makes a little bit more sense. But hopefully, we're able to implement a few of these things that keeps more money in your pocket. That's the end goal. Uh, so for one, I just want to thank everyone for coming tonight. Two, I also want to spend a special thanks to Jim. Jim sent a few questions before we got started tonight. Two of them are a little bit more specific to you. One of them is, the other two I could touch upon now. Something that does come up. Let's say you're going to move out of state, and everyone says the New Jersey, what is it called? Where they tax you because you're leaving, the exit tax. It's not an exit tax. So what it is, if you sell a property, they're going to withhold 2% of it. Because what they don't want to have happen is you skip town, don't do your final New Jersey estate return, and now they got to track you down in Arizona because you're already gone. So they typically withhold 2%. Then when you go to do your taxes, you might owe more or less than that. And as long as you square up when you go do your personal tax return the next year, you're fine. So it's not a situation where they're just keeping a chunk of it. The other point that was brought up was situations where, hey, we're still working part-time. What about Social Security? How do we massage that? And then that all goes back to, everything is kind of like a mixed bag of, all right, we got all these types of incomes. Where are the brackets? What makes the most sense? So there's nothing unique about working part-time in retirement. It just gets factored into the equation. There might be situations where we say, it makes sense to do part-time and earn 20 grand. But if you want to earn an additional 10, you're going to get taxed to the point where it might not even be worth the work. These are the different things that might come up. Or we might say, all right, because you're going to work part-time, let's hold off on Social Security for a year, and we'll just supplement a little bit from your investments. Stop the communication. Yeah. So as I say that, on the bottom of your screen is a raise hand feature. If anyone has any questions at this time, I'm happy to answer them. Okay. Again, thank you so much for coming. If anything, you want to have any follow-up conversations, feel free to shoot me an email or give me a call. Thank you so much, guys. Have a great night.